Reserve Bank of India has put out a revised set of guidelines, a revised circular for co-lending by banks and NBFCs to priority sector. The Reserve Bank is saying that it has been decided to provide greater operational flexibility to the lending institutions, and the primary focus of this revised scheme is going to be to improve the flow of credit to the unserved and underserved sector of the economy and to make funds available to the ultimate beneficiary at an affordable cost. And this new model, new revised scheme, is going to be called CLM or co-lending model. So what is priority sector? Well, mainly priority sectors are those sectors that require hand-holding by banks, by the government, by financial institutions to lend to them so that there is growth and there is a certain amount of development happening in those sectors. Which are these categories? Mainly agriculture, MSME, export credit, education, housing, social infrastructure, renewable energy, etc. In fact, very recently the RBI had also added a few more categories under priority sector lending, including startups, loans to farmers for installation of solar power plants, for solarization of grid-connected agriculture pumps, and also loans for setting up compressed biogas plants. So these were new priority sectors that they had added, new categories that had been added by the RBI. Now, what is the RBI saying in terms of the new norms that have come up? They're saying that now banks are permitted to co-lend with all registered NBFCs, including housing finance companies, because earlier banks were not really allowed to co-lend with all kinds of NBFCs. The categories that were included were NBFCs, non-deposit taking, and systemically important. So those were the categories that were allowed as per a 2018 circular that had come on, and now all NBFCs, including HFCs, are allowed. So what are the other points that the RBI has mentioned? That the co-lending of banks will take their share of individual loans on a back-to-back basis in their books. However, NBFCs shall be required to retain a minimum of 20% share of the individual loans on their books. Apart from that, the banks and NBFCs should formulate board-approved policies for entering into the co-lending model, and based on these board-approved policies, a master agreement may be entered into between the two partner institutions, which should include terms and conditions of the arrangement, which include sharing of responsibilities, the specific product lines, areas of operations, as well as customer interface and protection issues. So all these issues should be mentioned in the master agreement that has been signed by the banks. Now, the additional points that are mentioned by the RBI is that the master agreement may provide for the banks to either mandatorily take their share of the individual loans originated by the NBFCs in their books as per the terms of the agreement, or to retain the discretion to reject certain loans after the due diligence prior to taking those loans in their books. And lastly, RBI is saying is that the banks can claim priority sector status in respect of their share of credit while engaging in the CLM adhering to the specified conditions. So this is the view of the RBI. The aim is basically to provide more operational flexibility, to give more options for banks to lend, along with HFCs. An announcement that had also come in the policy announcement by the governor, and these are the points that have been made in the new circular.